Hello and welcome. Thank you for being part of Equivault Company. Today, we are starting our journey together with session number 6. In today's session, we are going to talk about Introduction to Fundamental Analysis, which one focuses on news, data, and events that move the market. So we will see how to read the Forex economic calendar. Next, we have the Suggested Analysis, PDF. A report created by experts that summarizes possible market movements. We will teach you how to understand. The first tool we use is the Forex Economic Calendar. This calendar shows the dates and times of key economic events. To access market news, we will visit the following website, www.thecribmarket.com. We look at the top of the page, where we'll see different sections. We'll select Tools, then Analytics, and finally, Economic Calendar. We'll be redirected to another tab. Scroll down to see a very similar table. Each column has a title. The first change we'll make is set the time and date, so click on the date and time to change it to your current time and date. Once changed, we'll know the time each event will occur, depending on the currency we're interested in. Each event has an impact level, low, medium, or high. High-impact news can cause strong movements in the market. When reading the calendar, we'll focus on 3 things. First, the country or currency affected. Second, actual data compared to the forecast. Third, the time of the release, because volatility often happens immediately after. Now, we will focus on 3 important columns: previous, forecast, and actual. These numbers tell us how strong or weak an economy looks, and they often decide if a currency will move up or down. I will summarize it in 3 simple steps. Step 1. What do these numbers mean? Previous shows the last reported number. Forecast is what analysts expect this time. Actual is the new result that just got released. The market usually reacts to the difference between actual and forecast, not only the number itself. Step 2. Why is the comparison important? The market reacts to expectations. If the result is lower than expected, even if it's better than the previous figure, the currency can fall, and vice versa. Step 3. Positive or negative? How do we know if the result is positive or negative for the currency? It depends on the type of data. For growth data like GDP, jobs, or retail sales, higher numbers are usually positive. For inflation or unemployment, lower numbers are usually positive. So, always check if higher is better or lower is better for that indicator. Important tips. Sometimes, even if the number looks good, the market reacts differently because traders already expected it. The central bank's policy changes how the data is interpreted. The bigger trend or sentiment is more powerful than one report. Once understood, we move on to the next topic. Now, I'll show you how to read our Suggested Analysis, PDF, a quick, expert report that highlights likely market moves and key levels. Step 1. Start at the top. Confirm the date and that you're looking at the latest report. This avoids trading on outdated levels. Step 2. Pick your instrument. Each section focuses on one market, like one pair of currency, GBPUSD or XAUUSD, gold. Choose the one you plan to trade. Step 3. Read the bias in one sentence. Look at where the arrow is pointing and what color it is. If the arrow is red and points down, the market is bearish. If the arrow is green and points up, the market is bullish. So bullish, the plan favors buys. If bearish, it favors sells. If range, think support resistance bounces. Step 4. Mark the key levels. Identify support and resistance. Draw them on your chart. These are decision zones. Price often reacts there, reversing, faking out, or breaking through. The recommended time frame for analyzing the market is 4 hours. Step 5. Check the indicators, but don't worship them. You'll usually see notes about moving averages, RSI/MACD, or trend lines. Use them to confirm the bias, not to replace it. For example, bullish bias plus price above a rising MA plus RS. I, holding above 50 equals stronger case. Step 6. Note the time frame. If the idea is on H4/D1, be patient and use wider stops. If it's M15/H1, expect faster moves and smaller stops. Match your trade size to the time frame. Step 7. Find the trigger. Look for recommendations like buy trades above a specific price and place your target or take profit at a certain price level. Sell trades below a specific price until the target price is reached. Your trigger might be a candle close beyond a level, a retest that holds, or momentum picking up. Step 8. Plan your risk. Place stop loss beyond the invalidation level, not at the exact line. Set take profit at logical targets, prior highs, arc lows, next supply, demand, or measured moves. Keep a consistent risk per trade. Step 9. Cross-check the calendar. If high-impact news is due soon, expect volatility and slips. You can wait for post-news structure to settle before entering. Step 10. Execute and review. When price reaches your trigger, execute your plan. After the trade, journal the result. What worked, what didn't, and any deviation from the PDF or your rules. Thank you for your attention. Keep learning, keep practicing, and we will meet again in our next session.